All right, I'll just give it a shot. Okay, hi everybody. This is my attempt at a YouTube video to try to make up for that analysis I promised that I never delivered on Wednesday. So here goes. Now, Martin asked me a question in, in the chat about that I vaguely interpreted as renewables, carbon-free energy generation, which I thought might be a useful topic to bring up in this forum. So I decided to look into that a bit and see if there was anything we could find in the utilities sort of category that would fit our needs. So I have this one here that I'm going to share with you today. So today we're going to talk about Atlantica Sustainable Infrastructure, which is a company that manages renewable energy and other power and water assets. AY, or Atlantica, is a UK headquartered firm that owns and manages energy generating assets, founded in 2013, with a market cap of $3.6 billion. Now they own and operate about 2 gigawatts, that is 2,000 megawatts of renewable energy and other generating capacity. So about, as you can see in the pie chart here on the right, 72% of the capacity is classified as renewable, which is wind and solar mostly, and then on top of that there is some natural gas, transmission lines in Chile, and some water desalination capacity in Algeria. Altogether, they own 29 assets, and the thing to know about these is that they run on all of them run on PPAs, which is power purchasing agreements. It's sort of like the net leases that Realty Income that we discussed last time has, which is to say that you have a long-term contract with a guaranteed power purchase at a certain price, and that price also often has an inbuilt escalator, which is to say that it increases slightly every year to compensate for inflation. Now, the geographic diversification of these assets is pretty evenly spread across the Atlantic. One fourth, 40%, 41% in North America, 36% in Europe, and then also a little bit in South America and the rest of the world. Now, the business model here is first, you generate growth by investing in new assets with long-term contracted revenues, purchasing power agreements that gives you predictable cash flows. And then you hold these assets, each of them in self-standing subsidiaries that you sort of use to ring fence the mother company. You take out non-recourse debt to finance investment in solar plants and windmills and power lines and desalination facilities. So non-recourse means that the lender, if anything would go awry and the company would get in trouble, the lender can make claims on their assets, but none of the other assets that Atlantica owns. So that's hence the ring fencing of the mother company. So this kind of setup is common in this business and allows them to take out more debt and to safely carry more debt on their balance sheet. Now, Atlantica maintains a balanced portfolio, as we've seen, in terms of geographic exposure and in terms of different types of energy. And they prioritize a good balance sheet. It's important to know that a good balance sheet is paramount for this sort of business. Again, we can compare it to Realty Income, where it's a very capital intensive business. They own these hard assets, and so a lot of that is financed by debt, and that's why you need to really keep your balance sheet in good shape and make sure those credit agencies give you good credit scores so that you can borrow more cheaply. Okay, that's a bit of a mishap. As you do that, you also pay out your cash flow in dividends, and in this case, they typically pay out about 80% of all their free cash flow as dividends. Now, what we see here is a very good overview of all the assets that they own and a sort of a breakdown of the power purchasing agreements, their duration, and the debt associated to them. So if you, for example, you take a look at the top one, Chile TL3, now that's a power plant that has a guaranteed purchasing power agreement until 2049. So that's about 28 more years of guaranteed income for Atlantica, and it has no debt associated to it. It's already been paid off, so that one should be pretty profitable and contribute to margins. And then the second one, this ATS, is has a term for debt payback that's still going on until 2043. So I suppose the way to interpret that is to say that it's still going to be profitable. I mean, because they're in it, so clearly it must be profitable, but perhaps less so in the first 21 years of the agreement, and then in the last year it will be more profitable. So what you can see here on in general is that there are a lot of these project debts that are going to be paid off. Like in here in 2027, a lot of them are going to have been paid off, and so margins for the business should improve here in these years going forward. Like these contracts often have built-in sort of extension options as well, that you make some changes and you do some renegotiations, and then you have you're in a good position to renew them for another long term. So all of this, of course, contributes to the relative ease with which you can forecast the earnings of this business, which is a good thing. Okay, let's try to apply our checklist for our research process that we discussed several times and see how Atlantica comes out on that. First, if we look at dividend safety, so how safe is their payout to their actual cash flow? Now, they use a different measure than free cash flow that they call cash available for distribution. And according to this measure, in the third quarter of last year, they had a payout ratio of 82.5%, which is roughly speaking where they've been all along. So that's in their goals to stay around that level. So that checks out pretty well. This is also a UK domiciled company, so you don't have to pay any taxes on your dividends, which is an extra bonus. Now they've been able to deliver growing earnings and cash available for distribution. If you look at Fastgraphs, you can see that they have been able to average a growth in operating cash flow of 7.25% over the last 8 years. So that's all of the time that they've been listed on the stock market, essentially. So that's pretty good. Credit score, though, is still not where it needs to be. The company's only been public for 8 years, so it takes time to build a reputation and a good credit score. And so far, it's only BB plus, which is not where we usually consider investing. But in this case, they just got upgraded from BB to BB plus, which sort of indicates that further upgrades are coming down the line as long as they toe the line that they've set. Fitch upgraded them in March 2021 from BB to BB plus because they see the stability and the strength and the sort of predictability of this business model, and that Atlantica has now delivered on that, what they've said they would do for a number of years. So that's a positive. But I would still like to see them strengthen the balance sheet and get further upgrades before I would go in big time into this company. Okay, we have business model strength. If you take all the debt on all of these 29 projects and add it up, now it's sums up to more than the entire market cap of the company. So from that perspective, it doesn't look very good. Um, Even though, as I said before, it's the debt is ring fenced, so that sort of alleviates that a bit. You have return on equity and return on invested capital that is actually pretty bad. Of average has averaged about 0 to 3% per year for this period. However, cash available for distribution margins have been impressive, and that is how you get paid. So that's a positive. Now, as you said, the strength of this business model depends, of course, on the balance sheet, how strong that is, because of how capital intensive this business is. So the management clearly seem to understand this, and they've placed the health of the balance sheet front and center of their operation. Now, do they have a moat? Do they have a sustainable competitive advantage against competitors? Well, aside from the fact that energy utilities are a natural monopoly, they don't really have any other obvious natural advantages. Their skill at managing capital and at managing their debt is, of course, it's good, and how they diversify and things like this are meaningful, but it's not really something unique, and it can be replicated by others. So I would say it's a very narrow moat at best. A plus is that they're almost immune. This sort of business is almost immune to COVID-19, and that's, of course, a big plus because people need energy no matter what. Okay, so what about management quality and their transparency? Well, if we look at insider ownership, it's not really significant. The CEO owns 20,000 shares, and his background, if we sort of look at his LinkedIn page, is that he's run this company since it became public. That's good. He's been there for more than 8 years. Before that, he was the CEO of the main shareholder of Atlantica, which is Algonquin. It's a Canadian diversified electrical utility. So that's good. He has a very long experience in this business. And before that, he's a McKinsey guy, so that's another plus. So we're just trying here to verify that he didn't get this job because of his uncle or something like that. So that can clearly be written off. Of course, they have a shareholder-friendly culture as well. I mean, the entire point of this sort of company is to pay strong dividends that also grow at a pretty fast rate over time. So yes. They haven't done any buybacks because there hasn't been any reason when they've been a listed company to do buybacks, since the company hasn't really been crazily undervalued at any point. I mean, it is renewable energy after all, so this kind of company tends not to get too unpopular. They increased the share count by about 10% in 2021, and that's normally a bad thing. But since you get diluted by 10% if you're a shareholder, but if they manage to invest the money they raised in this fashion with a high rate of return, then the dividend, which is currently 5.35%, then it should theoretically be a good thing for existing shareholders, and they are likely to do this, of course. The CEO has been with AY, as I said from the start, and then the fact that he's from Algonquin, and the fact that Algonquin owns 44% of the shares is sort of a dual-edged blade. Now, on the one hand, you have a strong, financially stable backer that helps your credibility if you want to make acquisitions or if you want to refinance your debt or things like this. But it could also be there's a theoretical risk that they could sort of use Atlantica as a dumping off spot if they want to drop down some of their own assets that are perhaps not the most optimal assets, not or let's say it's imaginable that they have some assets that might need significant investments to continue to be profitable, and they might want to get rid of those to make their own balance sheet look better, so they drop them off to their subsidiary, and that might be good for shareholders of Algonquin, but it might not be the best thing for shareholders of Atlantica. That sort of thing has happened in some industries with this sort of setup, but it still remains a theoretical risk in this industry and in this with this particular companies. So, but be aware that this sort of situation exists when you have a very strong dominant shareholder where there might be a conflict of interest sort of situation. Okay, what about the valuation? Well, first, we value these sort of companies on not on earnings but on cash flows because they have they have to take lots of write-downs every year. That makes earnings harder to read, so to speak, since it's such a capital-intensive business. So for accounting reasons, let's check Fastgraphs here. We have let's see from okay, we can't get quite all the history here, but I can get from 2016. We started at 17 bucks, and today we're at 32. So if you've gotten a decent rate of return if you were in this from the start. The company is valued on average at 6.36 times operational cash flow, which is quite a bit lower than what it should be worth. Now it has always traded here, so in this case I would say the blue line, which is the average multiple, is a good representation of where you might expect it to be in the future. So it got a bit ahead of itself here at the beginning of last year, all the way up to $46, but now it's come down a bit since, and if you start buying now, you get a dividend yield of 5.35%. That is to say, you get a guaranteed rate of return, more or less, of 5.35% every year if you buy this. And then you can also expect that probably to increase by roughly 5 to 8% every year on average over the long term. Okay, so if we buy this now, where can we expect it to be in 2 years if it trades at its average multiple, which we are at right now? Well, let's check it out. Okay, last December of 2023, we should have made 10% every year. Some of that in the form of dividends, and some in the form of share price appreciation. So that's about that should be about average, with the caveat that the market is probably going to do worse. As we have seen, the market is quite overvalued, so it's unlikely that the index is going to do this well over the coming 2 years. Unlikely, not guaranteed, but it seems unlikely. So this is pretty good, especially for a predictable and sort of safe business model as this is. Okay. So if we sum it up, we have 7 green checks and we have 4 red checks. So it's kind of it's an okay company, I would say, because it's a young company. They still have some things to prove. I mean, they're following their own business model, and that seems to be working, roughly speaking. So what I've done is that I've bought strongly under 30 bucks. I thought that was very attractive, so I bought quite a bit there, and I would consider buying all the way up to $35, but perhaps not more than that. And I would, of course, limit my exposure as well, because this is not a top quality company yet, like some of the others we've discussed before. So I would suggest 1% of the portfolio in this company at most. But if you like this sort of predictable business model, if you want to invest in renewables, especially with a heavy tilt to solar power, that seems to really have the future in its favor, then this is not a bad choice, and it's not trading at crazy prices either. It's a very reasonable price. If you buy now, you can expect 5.35% dividends, and those are going to increase by 5 to 8% every year on average. And you don't have to pay withholding tax, which is sugar on top. So that is my take on Atlantica Sustainable Infrastructure. Thank you very much.